Hi, Steph. Thanks for doing this. Really chuffed that you're talking to me. Obviously, the Chief Investment Officer for Stashaway. You oversee 5 countries, and unfortunately, we're not doing this in person. You're giving us the privilege of your knowledge from Hong Kong, for which I'm eternally grateful. You've obviously, I think you've been at Stashaway for a number of years, but you've joined Stash, the robo advisory, from the fund management industry. And you also spent a considerable number of years in Goldman's as a trader. Maybe you can talk about your transition from fund management, if you could, from Goldman's to fund management, and then on to Stashaway. What made you go into this line of the industry?
Yeah, it's been a long, long time, I guess, since I first joined the industry. So I initially actually wasn't thinking about going into investments. I actually did computer science in my undergrad and my master's degree when I was studying in the US. But that was kind of year 2000, and we had the internet bubble, of course. And I was actually trying to come back to Asia after I graduated. So of course the like back then there wasn't a lot of very, very cool tech jobs in Asia. So through recommendations from my friend, I mean they were like, okay, do you want to look at investments, or do you want to look at the finance industry, which was booming at the time. So I guess just by a lot of like a bit of coincidence, I got into McKinsey first, and then later on I moved to Goldman Sachs, and I spent about 7.5 years there. So I think to me, investments is actually a very, very interesting topic always, because things are always changing. And the reason why I love computer science was because you're always solving a problem. And to me, investment is actually a gigantic problem that gets like thrown at investors every day. So every day I come in, there's new puzzle to be solved. And I think it's if you think about computer science, it's always kind of one or zeros, black and white, whereas in investments is never black and white. You never work with full information. There's a lot of gray areas. To me, it's a bit of a combination of art and science. I mean, the science part is, of course, there's a lot of math, calculations, data involved, but also there's a lot of human side of things to investments, right? When you think about investments, it's sometimes it it's sort of like trading for yourself as well, because you have to overcome a lot of human behavioral bias. So to me, even though I've been in the industry for like 20 something years, it's never been a boring day, and I mean I could do this all my life.
Fantastic. I can tell you love your job. We've talked about volatility and black swans. In fact, I just saw Nicholas Nassim Taleb on CNBC, and he is the writer of Black Swans. You know that seminal book about unforeseen events, and it just seems that we live in an era where unforeseen events have become almost like de rigueur, right? Part of the fabric of developments. How do you, as a chief investment officer, allocate capital wisely for investors when there's so much uncertainty out there?
Yeah. So I think Black Swan events are, of course, called Black Swans because they're very, very unusual. In fact, why you would call them left tail events, because if you look at kind of distribution of returns, they are very negative, but they are very, very rare. So they occur at the very left tails. But it doesn't mean that it don't happen. And I mean, I think we've been through a few of these to sort of have an idea of the frequency and also the consequences of such things happening. So, for example, the last one was COVID, right? And perhaps the ones before were the China meltdown in 2015, the European crisis in 2021, and of course, a great financial crisis in 2008. And we can go back in history and list out many other different sort of so-called black swan events. So even though they don't occur that frequently, they do occur. And I mean, it causes stress in the market. There's a few things that always happen. Number one is that you will see significant drawdowns. So, for example, equity markets could see drawdowns 30%, 50%, even further, depending on, I mean, of course, what market you're looking at. But broadly speaking, I mean, if you look at kind of global markets or global equity markets, that's the magnitude of drawdown that you can expect. The second thing is that correlation always goes to one. What I mean by that is that if you invest in a basket of stocks, I mean, all the stocks are going to fall. Like, it doesn't matter if you invest in Google or Amazon or Chinese equities or US equities. It doesn't matter. Everything falls. And also, I think if you look at kind of how different asset classes perform, typically these asset classes initially fall at the same rate. So i.e. correlation goes to 1 because everybody needs to take off risk. But then over the course of that crisis, you would see divergence in performance. What I mean by that, for example, if you think about broader asset classes, there are roughly like 4 of them. Number one is, of course, the safest one is cash and cash equivalent. In a crisis, like actually, I mean, cash remains cash, right? Unless we're talking about maybe some emerging market currencies and you're going through emerging market crises. Of course, that's very different. But if you, let's say you hold US dollar, I mean, US dollar remains US dollar. And typically in a crisis, the Fed actually cuts interest rates. So the return on the US dollar actually would start to deteriorate as you go through a crisis. Second is bonds, right? And if you're going through a crisis, typically, I mean, bonds would actually outperform because in a crisis, actually growth slow down. And as I mentioned, the Fed typically cuts interest rates. And when the Fed cut interest rates, typically that benefits bonds. The third asset is gold, and I mean gold equivalents. And historically, I mean gold has also been a good safety asset because as a crisis plays out, more people will flock to gold as safe haven. And it also depends on what kind of crisis we talk about, right? For example, if it's a concern on geopolitical kind of risk, then or if inflation is a concern, then typically, I mean, gold performs even better than bond as a balanced asset. And then lastly, of course, is equities and other risky assets. And typically in a crisis, risky assets get hit. But what we can know for sure is that over time, it will recover because from every crisis, I mean, you would get policy response, you would like the world would actually move on. And if you zoom out to a long enough time horizon, actually during these crises are the best times to get into equities. So I think what's important is to kind of understand these different asset classes and how do you use these asset classes to construct resilient portfolios. And that's what we do at Stashaway, right? That's why we put together these 4 asset classes in different mixes so that we can help our clients to navigate through these kind of crisis periods. Because for sure, one of them will happen. We don't know when, but when it happens, having these sort of balancing assets to help you to kind of offset some of the drawdowns of equities could actually help you to stay invested and then reap the benefit of uh, equities actually outperforming in the long term. And that to us is actually central to how we think about our portfolios.
Yeah, so we're living right now in 2025. We've got these kind of like mini black swan events, whether it's what's happening in Iran, between Iran and Israel. You've got the Middle East conflicts going on. You've got the war in the Ukraine. You've got these tariff talks going on, and everybody seems to think Trump doesn't have a method to his madness, right? At the same time, these asset classes you talk about, cash from a monetary policy perspective doesn't make sense to the whole cash because it's just been, I think it was Ray Dalio that said cash is trash, isn't it, right? And then you've got the bond markets and yields are going through the roof. So it seems to me that people are just, they're just dumping bonds because, and obviously T-bills, from the US dollar perspective, nobody wants to hold dollars anymore. So there's all these things going on, right? So to get some kind of meaningful return to investors, and meaningful could mean something in the order of 10 to 15% a year, just to get a reasonable hurdle rate passed, right? What would be an ideal allocation for 2025 going into the second half, Steph?
Yeah, so at Stashaway, we offer 12 different risk points, meaning that for investors that range from very conservative to very aggressive, we offer different portfolio configurations, right? Because I think over the long run, the more you can, the more risk you can stomach, of course, like the higher your long-term return would be. So the highest return is of course 100% equities, but also then you need to be able to stomach 30 to 40% drawdowns in a worst case scenario. And not everybody can sleep at night with that sort of drawdowns. So what do, right? You kind of go down the risk curve and ask yourself, like, what is the maximum drawdown I can withstand in these back Swan events? For a lot of our investors, that's maybe 20%, right? So it's sort of in the middle, moderate risk. And I mean, what we do for these investors is that we add in mixes of other balancing assets. And I think if I look at the current situation, there are a few things that we think would continue to play out, not just this year, but over the next 10 years maybe. And actually, earlier in the year, we published our CIO insights for the 2025 outlook. And I've actually titled it "Fat is the New Normal." So FAT stands for FAT. And I think these three words capture very, very well the ongoing themes that we are expecting. So what does FAT stand for? F stands for Fiscal Dominance, meaning that, I guess if you take a step back, since 2008, the business cycle has been driven a lot by monetary policies. So, for example, is the Fed increasing interest rates? Are they cutting interest rates? However, if you look at now, there's actually not that much room for central banks to increase or decrease policy rates. However, what's actually taking over is actually fiscal policy, right? There's a lot of fiscal stimulus going on globally, not just in the US. I mean, even in Europe, like Germany is actually spending money on infrastructure, on defense, right? So we think that this is going to be an ongoing trend that affects in the investment landscape. So fiscal policy is one. The second word in FAT is AI, right? A stands for AI. And we think that actually AI is, I mean, not just a bubble, but it's actually a very, very important kind of technological shift, perhaps, I mean, even bigger than the internet. And it's important as investors to continue to sort of pay attention to what's happening within the AI space to capture, I think, the most kind of the best investment opportunities. I mean, we've seen this playing out in the Mac 7 in the last 2 years. So what we think is that over time, this sort of theme would broaden out to companies that are outside Mac 7. So, for example, this year, if we look at US equities, sure, it had a dip, I guess, in April because of all the concerns of trade tariffs. But as the market recovers, we're seeing kind of new leadership forming, right? Software companies like Palantir, like Duolingo, or even some SaaS companies, and they are kind of the new leader in this recovery phase. And I think that's because AI is actually expanding, and the benefits of AI are getting realized in companies other than, I mean, NVIDIA, other than like the big cloud companies. So that's the second theme. And then lastly is T. So I think like everybody would have guessed what T stands for. It stands for Trump, right? So I mean, how is Trump handling the kind of I guess the relationships with other nations has a lot of implications for how we should think about asset allocation as well, right? So, for example, early in the year, I think one of the most kind of crowded belief was that U.S. equities and U.S. bonds and U.S. assets would continue to outperform the rest of the world, right? This is called U.S. exceptionalism. Now, of course, with the Trump policies, that raises a lot of questions for European investors, for I guess other Japanese investors or even Chinese investors to think about whether or not by default they should overweight U.S. assets. And that creates a lot of very, very big implications in terms of asset and allocation flows. So I think that basically summarizes how we think about asset allocation. And I would encourage every investor to think about your portfolio in those three kind of tangents as well, because I mean, it's going to continue to affect asset prices going forward.
Yeah, I want to get your thoughts, Steph, on two things in particular you raised. The first thing, obviously, is Trump and what he means for markets, right? But before I talk about Trump, the US is going through this huge existential crisis where its fiscal position is concerned. It's got this huge debt of something like $37 trillion. That's with a T, which it appears to not be able to get itself out of. So from an asset allocation perspective, right? How do you deal with the fact that the US might implode because it can't pay for its debts anymore, and B, what is going to happen to the dollar as a reserve currency if people don't have faith in the dollar anymore? So that's before we even talk about Trump.
Yes, exactly. Well, I guess it's sort of I mean, Trump sort of accelerated or kind of reignited the concern to a certain extent. But I think um before we talk about how we position for it, I think it's concerns are great for headlines, but I do think it's a bit overblown. At the end of the day, I mean, US dollar is still reserve currency. I mean, we still kind of use US dollar for a lot of transactions, like global trade, global transactions. And I mean, to be honest, if you look at kind of even like US assets, like US equity market is still very, very vibrant. It has a lot of the biggest, like the best companies in the world. It still generates a very, very high rate of growth. And if you look at AI, a lot of innovation is still happening in the US. US bond market, yes, there's a lot of concern on US debt. But I think if you kind of compare US versus other nations, there is still no credible alternative to challenge I guess the position of US dollar and US assets. So yes, I am concerned about US debt, but I think to say that overnight US becomes uninvestable, I think that's a bit overblown. These things happen. I think if you read Ray Dalio, he has done a fantastic job of just going back to history and seeing how nations rise and fall. But these things don't happen like overnight, right? They don't even happen in decades. They happen over hundreds of years, like kind of beyond our lifetime. So these are very, very slow moving things. Of course, we need to be aware of them because I think these are undercurrents that would affect investment landscapes. But sometimes it gets a bit too sensational and too overblown. So that's number one. Secondly, to your question about how we can position for them, actually last April, we've actually made some changes to all our portfolio benchmarks. And we've actually included gold in all our asset allocation portfolios. So if you think about benchmarks, I mean, these are basically kind of strategic allocations that we would try to adhere to over time. But of course, in the short term, because of the changes in economic cycle, we would overweight and underweight certain assets. And if you think about a traditional benchmark for multi-asset allocation models, they typically benchmark themselves to a 60-40 or like 70-30, meaning that it's made up of two assets, which are equities and bonds. And in a moderate risk portfolio, that's typically like 60% equity, 40% bond. There's no strategic allocation to gold. What we've done is that we've actually included gold in all our strategic asset allocations. And why? It's exactly because of the issue that you've raised. US debt is going to go through the roof in the next 10 years. And that's going to create a lot of questions about, I guess there's going to create two things, right? Of course, number one is question of how sustainable it is. But also secondly, I think it makes US bonds less attractive as a safety asset. Because if the US government, if you think about like what is a bond, right? A bond is basically a claim on somebody who borrowed money from you. So let's say you buy US bonds. So that basically means that like the US government borrows money from you, right? You're lending money to the US government. And if you think about you lending money to somebody who continually kind of keeps raising his debt and is unable to like kind of balance his budget, I mean, would you actually demand higher returns for lending money to that person? Yes, of course, right? Or at some point you think about, okay, I mean, your financial situation is too bad. I can't lend money to you. So this is actually what's happening with US debt. And that's why I think over long term, yes, I mean, the US debt is perhaps less safe than it was for the last 20 years. And that's why if you look kind of at other alternatives, there's no, as I mentioned, I mean, US is still kind of the best sovereign, so there's no good sovereign alternative, but there is gold, which is very, very neutral, very independent, very limited in supply, and I think that's sort of the alternative to holding sovereign. So that's why we've included gold in all our asset allocation portfolios. And of course, I mean, touch wood, year to date, gold has performed like very, very well. Actually, I mean, gold is up 25 to 30%, and it outperformed like every other single asset class. So I think that is a way to try to navigate that problem, and that's why we will have it over the long term.
Yeah, so gold has been asleep, I think, until the last 2 years, right, Steph? And now it's gone up to like ridiculous levels, $3,500 an ounce or something. And it just seems as if it looks a bit toppish at this point in time. Do you think, where do you think it goes? Because what you're suggesting is a long-term cyclical play into gold because of the US debt concerns. Does it go to 5,000? Does it go to 7,005? Does it go to 10,000? People like Peter Schiff would say it goes to the moon, right?
Yeah. So so I think it's important to remember that gold is a balanced asset, right? It's an alternative. Like, what is gold actually? Because I mean, gold, sure, it has uses for jewelry, but I mean, realistically, it has no use. And you hold it for store value. You hold it for alternative store value compared to whatever currency that you have, like US dollar, Malaysian ringgit, Singapore dollar, whatnot, right? So that is the trade-off that you have to make, right? If you have, it's not a, I don't think it's a comparison. It's not valid to compare gold, for example, versus equities. Because if you invest in equities, you're actually investing in companies that actively create growth, right? That actively creates shareholder value. I mean, gold is just a block that sits there. And the value of gold actually is relative to the value of all the other alternatives, which are all the other currencies, right? So, for example, uh, if you have cash, you can put it into the bank, right? So when you put cash into the bank, several things happen. Number one, the bank pays you interest, so that's your income. Number two, your currency can appreciate or depreciate versus gold. So that's capital appreciation. So I guess the way to think about gold is, do you think holding gold can compensate for number one, the interest rate that you're going to get, and number two, the relative performance of gold versus whatever currency you're thinking about? Now, to me, I think gold actually could win over US dollar on both counts because of number one, I think, as I mentioned, I mean, the concern of US debts, but also secondly, there's a lot of demand for gold, not just from people like you and me, but more importantly from central banks. And I mean, they buy in much bigger quantities than all of us combined. And these guys are the big drivers. They have been the big drivers of gold returns in the past 2 years, and they will continue to be a big driver. So to me, it's about, so if you think about how you allocate assets, number one is what kind of risk appetite do you have, right? If you have very, very high risk appetite, for example, if you're very young, starting out, and I mean, you still have like 30, 40 years to retirement, and you can stomach 30, 40% like drawdown in bad scenarios, of course, like you should go for equities because equities give you the highest return. But if you're not, then you can start to think about, okay, so maybe I should just hold 60% of my net worth in equities. So then what do I do with the rest of that 40%, right? That's where gold comes in, right? That's where kind of having some sort of cash comes in, or even having some bonds, safe bonds, like corporate bonds can be very safe as well, right? So, or some form of credit. I mean, that's where kind of the safety part comes in, and gold should be part of that safety assets. So that's how I think about gold, right? As far as like I think near term is concerned, yes, of course, it seems to be quite stretched right now, just given I mean, if you think about 30% year to date, that's kind of if you analyze it, that 60% for 1 year, that's a lot, right? Of course, in short term, it can correct. But I think if it corrects, I mean, it could create like good opportunities for long-term investors to think about adding to that allocation, particularly if you hold a lot of cash.
Yeah, so on to Trump, because when he came in late last year, there was a huge wave of euphoria. And, Trump part one saw financial markets. I mean, he's a markets guy, right? He doesn't demonstrate, signs of being a warmonger, but because he's a business guy, he's a markets guy. He wants to see asset prices number go up, right? But quite the opposite has happened earlier this year because of what he's trying to do to kind of like fix the US debt situation. What is your view on Trump in terms of him managing this, the world's biggest economy, and I think financial markets most importantly because medium term, longer term, which directionally speaking, where do they go?
Yeah. So I think when Trump got elected, the market was actually quite happy with the outcome, because of two things. Number one, of course, a Republican president and Republican sweep historically has been very friendly to markets. And then I think secondly, if you look at kind of Trump's agenda, Trump's last term, a lot of the policies are actually quite pro-market. For example, the tax cuts that he's proposing, the sort of deregulation that he was talking about. I mean, all these are pro-market. Now, of course, like what we got was not what we hoped for. And in the past few months, we've been through quite a bit of market turmoil, also because of Trump policies. But I think it's important to think about the sequencing of things, right? So I think if you think about like what's most important for Trump or for the Republican Party, it's the midterm elections next year. So they need to be able to get kind of things sorted out in a very short time frame. And for them to be able to push through like tax cuts and also kind of fiscal spending, they need to get the budget sort of in line or in order. And what are some of the levers for them to get the budget in order? Number one is, of course, the Doge efforts, which has sort of come and go in a certain sense, with Elon Musk. I mean, they've claimed that they've saved $180 billion so far, but it's still kind of far from the 2 trillion target, right? And I think it's very hard to cut some of the spending, which are like, for example, healthcare and social benefits. I mean, these are very unpopular spending cuts, which is very hard to get through. So the second lever that they could have pulled or they could pull is increasing tariffs on like trade. And indeed, I mean, that's what they've been trying to do. And I think ultimately what they're trying to get at is a range of roughly 10%, which is acceptable by the market. So if you think about Liberation Day, when Trump announced that 10%, market actually rallied initially because like, market actually hates uncertainty. And if we get the certainty that the tariff is going to be at 10% and everybody just moves on, it's fine. It's absorbable by a mix of like currency appreciation, by kind of companies absorbing some margins and some of that like passing on to consumers. So I mean, 10% tariffs is fine. But what was surprising to the market was that beyond that 10%, there's actually a whole list of much more aggressive numbers that they put out. So I think if you kind of study like the 2016 playbook, it was pretty clear that, I mean, Trump has a certain strategy to negotiate, right? The strategy is to like put out some really big ask, put out some very seemingly unreasonable numbers, and to negotiate down from there. And that's exactly what happened in December 2016, right? Actually, the market had its lowest point on December 24th, because that was like when Trump was going through a lot of mess with China. But subsequently, I mean, markets all recovered because then, I mean, Trump was like, okay, I mean, we start from that very high point and we try to find a common ground kind of at a more kind of, I guess, a more acceptable range. And I think that's exactly what's happening right now. So even though, yes, it's pretty messy, but number one, I mean, it's not like we've never been through it. We've been through it before. And I think a lot of the profit taking back in April was because of stretch valuation and positioning in the US as well, right? Which now has kind of, I think, been a bit more balanced. Of course, we've had a very, very swift rebound. So I wouldn't be surprised if during the summer we have somewhat of a consolidation. I don't expect to see kind of another 20% drawdown, but a 5 to 10% consolidation, yes, like that's very reasonable. Of course, there's still going to be ongoing news flow from Trump, so I think it's good for like Twitter. It's good for entertainment, but I mean, is it that useful for markets? Probably not.
Well, there's a couple of other levers that perhaps people don't really think about. The first thing is the debt problem becomes less of a problem if interest rates come down, don't they? Right, rather than paying what is it 4.5%, 5% now, if they pay half of that, which essentially is kind of like a debt jubilee situation. And I think he's been trying to get Jay Powell to drop Fed President Jay Powell to drop rates, which he's not succeeding in yet. And the second lever could potentially be the productivity gains that come from AI. One of the things that he talked about in the Fed situation, right? And if that comes true and the robots can take over the economy, um, essentially GDP productivity could be infinite, because what's essentially been the component parts of GDP. One key lever is labor, right? And if labor is then being replaced by robots, well, then the sky's the limit, isn't it, Steph? So from that perspective, right? How do you play into those two themes? A, the drop in interest rates potentially, which I think is going to happen at some point, and B, the productivity gains from robots.
Yeah, I think those are great questions, and I think as far as interest rate goes, I mean the Fed is is going to be very data dependent, right? And so far with like the US data is still very strong. I mean, even though a lot of soft data was suggesting a slowdown, I mean, if you look at the employment data or if you look at the labor market, I mean, there's no sign that points to imminent risk of a recession, and therefore the Fed has been very reluctant to cut. I think and the market also thinks that in the second half we'll see maybe one or two cuts, which is not unreasonable to me. I think that's I mean that the inflation data has been a bit more benign, and perhaps I mean that gives the Fed a reason to cut. But I think the bigger question on U.S. debt is in terms of in the longer term sustainability, right? Because the Fed cuts interest rates, yes, it will affect the short dated bonds, but the long dated bonds are actually much more affected by the investors' outlook for, I mean, for longer time horizon. Of course, like if, like just think about the definition of long dated bonds, right? If you think about 5 years, 10 years bonds, I mean, it's not just about what the Fed does next month, right? It's more about, do I think that the economy of the US, the inflation of the US is going to be high or low in 5 years, 10 years time, right? And also, do I think that the debt situation is sustainable? And I think that's one of the biggest problems that Trump and to a more like I guess to a higher degree like Besson has, because I mean Besson is tasked with the mandates to get interest rate down and also to ensure that the U.S. can continue to finance its fiscal expansion by issuing bonds. And I think there are there are certain ideas that are being floated around, and I know there's an interest in, I guess, in expanding the use of stable coins or cryptocurrencies. I think partly that has to do with the U.S. debt situation, but also I think getting the house in order is of significant like, importance, right? Getting the house in order, meaning that getting inflation meaningfully kind of lower from current levels and stabilize. Because if you look at the last 20 years, we've actually been through a deflationary growth environment in which, I mean, inflation has been very low. That has allowed for interest rates to stay low for a very long time. That has allowed US companies to borrow money. And of course, it resulted in some boom bust episodes, right? But overall, I think that the continuing lowering of interest rates have actually drove prosperity for a lot of US corporates. Um, but of course, the with the ongoing kind of geopolitical concerns and also with the U.S. debt situation, um, and with I guess more fiscal spending, that could mean that interest rates actually or inflation actually stays higher for a higher time, or at least kind of volatile inflation is going to increase, and that I think is something that we need to kind of keep an eye on. AI, sure, yes, it's gonna. I think it has technology always has a deflationary impact. Um, but I think you have to sort of think about how quickly AI technology is gonna benefit I guess the workplace as well, right? There's I think the technological progress is very, very fast. And indeed, I mean, I'm experiencing that, right? My productivity has gone up, I don't know, 3 to 5 times because of the use of AI. But there's still a lot of, I think there's still a lot of concern about using AI from a scalable and safe perspective, like for corporates. For example, if you look at a bank, right? There's a lot of responsibilities that needs to be, or regulations that needs to be sorted out for a bank to fully use AI. And also for us, like as asset managers, because we are highly regulated, like can we use AI to give advice to our investors? Like probably not yet, right? Because I mean, every one of us here are licensed representatives. And how do we get an AI to become licensed? That's still not set up. So I think that, I mean, those are some of the hurdles to actually fully use AI in a lot of much more kind of regulated, much more structured industries.